Forget unicorn deals, off-market hacks, or 9% net yield hype. That's not what built this $5 million portfolio. In fact, chasing those kinds of deals is what might be holding you back. In this video, I'm going to show you how one client used 3 boring properties to build 164K in passive income with 0 development, 0 headaches, and no major renovations. Let's get into it. All right, so this client, Alex, Melbourne-based, but originally from the UK. He's got a bit older now. I think it's a 4.5-year-old and a 2.5-year-old. He's actually a skipper on super yachts, which sounds bloody awesome. And he's been doing that for about 15 years and just loves adventure. Funnily enough, he actually bought a fish and chip shop because he wanted to somewhat retire, get a passive income from commercial property. Bought a fish and chip shop, but then realized small businesses are probably more work than just being an employee on a super yacht. So he actually sold that and went back. But the start of it was he's really basically scared of actually just buying property. He had 2 properties in the UK, his principal place of residence in Melbourne with bucket loads of equity, and was just too scared to actually do anything else. But saw us on, I think it was Instagram, got our books, podcast, all that, and then obviously saw me selling the dream of the passive income life through commercial property. And then even though we had a big budget, he actually only wanted to dip his toe in initially. So we actually bought something well under his budget. So I think let's just get into it and go through it. Part of it is I had to introduce him to obviously a commercial savvy mortgage broker because his resi one wasn't competent. So that's probably the take home idea for you guys. Don't just go to your resi mortgage broker saying, what's my commercial capacity? If they're competent, cool. Go make sure they've got lots of commercial on board. But with commercial, there's so many different aspects to it. There's lease doc, low doc, just different entities, change your buying systems as well. So get all that kind of into it. Good accountant as well, because your different buying entity will affect your borrowing capacity as well. But yeah, basically we've pulled out the equity for the first one and just dipped his toe into it. He basically wanted to spend no more than 700K. I think from memory it was about 160K that he put into this deal on a high leveraged loan. But the main thing that we did, and it's probably worth actually having a bit of a get on my soapbox about. The main difference with probably us at Palise Property is I don't go for unicorns. A lot of buyers agents and investors will just chase yield. They'll go out and they go, oh, I want to buy this 7% yielding warehouse in Mount Isa, which looks great, but there's vacancy rates there like 1 to 3 years for a warehouse. Whereas if you go buy a bulletproof one, we bought one last week in Brisbane for 6%, that's going to have better rental increases, better capital growth, lower periods of vacancy. Your ROI is actually going to be way more, and it's been true. Like anything I bought 3 years ago is now yielding around 7.5% to 8% net because of the rental increases and not being vacant. You go and buy something in, say, Mount Isa, there's been no rental increases, and if it has gone vacant, it's a high vacancy. So the main point I want to take away is I don't buy unicorns. I just buy good quality assets. Good tenant, good location, tight vacancy rate, versatile premises. Just cover all the boring bases, because you still want the rental increases and capital growth. You're not going to just quickly retire off 7% net yield. If you're in the foundation stages, yes, then you need the capital growth to get you to the next one. If they're in retirement stage, which is when we get to his third property, it actually was a yield chasing one and probably less about capital growth and rental increases. So we'll go into that. But that's probably the key takeaway is stop looking for unicorns. A boring property will become a unicorn if you buy now. So let's get into it. Like I said, anyone just jump in and ask any questions. All right, first property. I've got some other details on the property, but I've tried to make it high level. So if you've got any questions, I can go through the exact cash flow, where it is, all that type of stuff, why we like the area. But this one was in Willawong, if any of you guys know where that is in Queensland. Nothing special about the property. Literally was just a good yield. Not even like a high yield at the time. We got a 5.7%. It was just a newer building, 630 grand. And we got that in 2023 at the end. So literally, what are we now? A year and a half later, he's got that valued at 950 just because we bought to the fundamentals. The cash flow at the moment is around 28 grand a year because he added to chunky deposit and with the rental increases. But again, just a simple dip his toe in, let's buy something that's versatile. So something like this can be anything. It can be like, it's probably not going to be like a big fabricator, but it's most likely going to be a storage, a little mechanic, maybe a spray painter, just a little service-based business, a window supplier. Most of the time it's going to be some form of e-distribution or storage or like contracting kind of company. But again, just little tick the box, body corporate property, just a good set and forget, nothing special about it. But as you can see, it's made around 320 grand without doing anything, just buying the fundamentals. Where I get a lot of clients that come to me and they want to make that 320 grand guaranteed. They go, oh, let's buy something with value add, which we do the value add. The issue with value adds is there's a risk with it. Like sellers don't sell a property below market value for fun. So there normally is something you need to do. If you're doing a value add, you typically, and don't listen to all the people who say, oh yeah, it's under rented, 30% will bump the rent up. If it was that easy, it'd probably be up already. But you normally have to throw some money into something like this, like do like a mezzanine, which might be instant necessarily, because then you got to wait for the tenant to leave before you do that, or have a chat with them and get it kind of done. So it means you're not doing it. If you've got a 3-year lease, you're not doing it for 3 years. You have to wait for the actual tenant to leave. And there's a risk that it could be rejected. So the common one why mezz floors are rejected, for instance, is there's not enough car spacing. If you increase the net lettable area by say 30, 40%, you need 30, 40% more car spots, which in a body corporate warehouse, you don't really get. So you've got to be mindful of those risks, plus the money up front, plus it not being approved. So quite a bit there, but this one wasn't a play for that. We probably could increase the mezz for a little bit, but these little cheapies, typically that's not what you do. Are there any questions on this one before I kind of jump to property number 2?
So Steve, was that tenanted when he bought it?
Yeah, that was tenanted. I can pull up, let me see if I can pull up the details. Yep, so that's why we've got the higher rent now. So it was tenanted until mid-2025, so i.e. now, and now he's obviously taking the next option and they've gone up the increase in rent. And that's where the yield went from, was it 5.7 to 6.2%. So you can see it's got the office space, just a clean, tidy warehouse. While we're into it, let's have a look. There's the floor plans. This is just a high level that I've kind of scraped together. We do like a proper due diligence report, which I'll show you on the last one because it's a bit more complicated, bit of area analysis. But this is probably worth showing you guys. Just having a look at the numbers, you can kind of see, we present deals like this with a big cash flow table. The reason for this is everyone's different from where they're pulling the money from. If they're pulling it from equity, it's say a 100% loan. If they're using, a 30% cash deposit, it's a 70% loan. And then I basically plan for all the different varying interest rates. So even if we're now getting around 6.5%, I know it could go up to 7.5. It could go down. Funnily enough, when interest rates are at like 7.5, this table actually went up to 9.5. So I always try to get it a couple percent either side, just so you can see where your cash flow is. But again, you guys probably know and been watching all my stuff. What I like about commercial is like even at a 6.5%, which is like a lease stock rate at the moment, you're literally 9, 10 grand a year positive. If you go buy a residential at this, you're 10, 20 grand a year negative. So there's a 20, 30 grand disparity in kind of holding costs, and hence why you can obviously push the limits more with a full doc loan with a commercial, and even more so if you get a lease stock loan. Just so for education purposes, there are, I think about 4 lenders doing lease stock loans now. They've changed it's called the ICR, the interest coverage ratio, from 1.5 to 1.25. And now as long as you get a 6% net plus property, you can get a 70% loan to value ratio on a commercial lease stock loan. Whereas when interest rates were higher, we kind of had to go around that 55 to 65%. So that's good for the people that if you can still get a 6%, you can just keep buying lease stock of that. If not, you might be going like a 65%. But this is kind of what I like about commercial, is just you can weather all the storms. And maybe at the end, I'll show you my stress test calculator, which I actually use just to see like break-even costs and things like that. This is just some comparison sales and all that type of stuff. So that's just high level, but we'll go back to the presentation.
Steve, just you've shown us an example which had a 50% growth.
Mm-hmm.
How realistic is that? Are you showing us a crackingly good example, or is this the norm, or put this into perspective for us?
Long term, expect 6 to 7% as an average. Like that's a realistic number because it basically goes in line with the residential. This one was just because the commercial market in the last 3 years, in Brisbane especially, has gone absolutely crazy. But we knew that. We saw vacancy rates were dropped from 7% down to sub 2%. And I can't remember the number. Willawong at the time I had like a 0.6% vacancy rate. And we saw all the rents were going up in the surrounding properties. So when we do our due diligence, you look at the comparable rents and either new ones coming up, the rents were getting bumped up 20, 30%. So that combined with general rental increases, the lowering interest rate, the tighter vacancy rates, that pushed up. But to answer your question, expect on average 7%. But as you know, property cycles don't happen like that. You'll have 5, 10, 15, 30%, 20%, 15%, 10%, 5%. It's kind of like a bell curve wave. We're just in the upswing of that. Funnily enough, I actually don't think the downswing of the bell curve is coming anytime soon, especially if interest rates keep coming down and sentiment stays high. And one of the other things we're not talking about is actually extra people interested in commercial. And this is testament. I did not expect 100 plus people to come to this. 5 years ago, if I mentioned the word commercial, people laughed at me. And now we've got 100 people on a webinar. There's 3 books in stores, like I've got one of them. There's 2 other podcast series. There's 4 other buyer's agents. It's becoming a well-known space. And that's a driver in itself. Having 50% more people, or probably more, 500% more people looking and the same supply is actually going to be a driver. So I personally, like you guys know, I just bought a shopping centre. I think commercial is going to be the front runner in the next kind of 5 years. And realistically, I'm expecting probably 50% growth in the next 5 years, and then it'll die off. And then the external factors of the economy, interest rates, lending restrictions, all that will kind of play a part. But the demand's still there. The vacancy rates have softened up a little bit. But again, the demand is still there. Funnily enough, 5 years ago, if you bought a tenanted property, it sold for way more than a vacant property. Generally 15, 20%. So trying to buy, part of the value add strategy was you buy a vacant property, put a tenant in it, and you get 50, 20% uplift that way. However, that wasn't great for every investor because you couldn't get lease stock loans. You need to pay GST because it's not a going concern, which you get that back on your first BAS statement. But all of a sudden, you don't have rent coming in, so you don't have servicing. So you need to have a good serviceability, pay an extra 10%, typically have a 40% deposit. You had to buy something like this, you needed 315 grand cash. And then you had holding costs, then you get a tenant in. However, now, pretty much in all the markets we're focused on, because we focus on buyer demand, owner-occupiers are buying properties at a 15, 20% higher return than tenanted ones. So we've had clients where we're doing an upgrading strategy. It gets to the end of the tenant lease, we're actually saying kick the tenant out and put it on the market vacant because a blue-collar kind of business will come in and actually pay 15, 20% premium. So that's a shift in demand as well. Paralleling that with, say, residential, if you've got a really good owner-occupier market where owner-occupiers are buying way more than investors, that's a pretty good indicator that long-term it's going to be all right. But there's no guarantees in this business. I was buying in Brisbane in 2014, I think was my first commercial. It did nothing for 4 years and then exploded. Now it's worth double. So it's getting in the market with a good quality asset. If any buyer's agent, any investor tells you got the secret sauce and can guarantee literally capital growth like this within a couple years, just run a mile. They're talking out of their bum. No one is that good. Otherwise, they wouldn't be talking to you. They'd be living in their private island in the Bahamas. So the main thing is just get in, tick the fundamental boxes. At least in 10 years' time, you'll be in a better position than you are now. All right, let's have a look. So it's got some sales stuff about why we liked it. So the rent was a little bit undercooked. The 2-year lease, actually this was the question, I should answer this. But yeah, we got the extra 15K rent coming in, 2025 now. Willawong's just a nice little suburb, tight vacancy rates, close to all amenities, surrounded by residential that's got a population growing. So that's one of the things that I like as well, and what we do in Palise property is we don't typically buy greenfield warehouses because it's very hard to guarantee the numbers. Because if you talk to town planners and they're building another 200 warehouses, I can't give you a guarantee on what the vacancy rates are going to be, what the rental increases are going to be. Yes, long term, it's fine. So what's an example? Like a residential example. I did a residential development in Box Hill in Western Sydney, for the people know what that is. I sold that straight away because vacancy rates went from 1% to about 7% because all the stock came on. Now it's fine, 7 years later, but during that time it would have been a tough time. So you can still be okay long term, but if you're buying an asset like this that's completely surrounded by residential, and you talk to a town planner and you look on the council website and they're increasing their population by 30% by 2035, there's going to be more people. I find it hard to make an argument to say there's going to be less demand for a warehouse when there's 30% more people, because you're going to need more trades, mechanics, service-based businesses, distribution-based businesses. That should equate to capital growth. There's external factors, but at least I know I've got an asset that's in more demand than it is going to be now. All right, next one. So this was in Malaga, if anyone knows. Again, probably an equivalent to a Willawong in Brisbane, but just in Perth. Slightly bigger one, 740K. Again, we actually bought quite a low yield for Perth. Like typically we're still buying now Perth 5.5 to 6%, but it was like good location, new building, good depreciation, ticked all the boxes, really tightly held complex. And then same thing, nice little cash flow, 13 grand on this one. The other one had about 8-9 grand. I believe he did a lease stock on this one from memory. Didn't use the funds though from the previous one to get into this one. This is going to be a strategy that we'll go in after. But same sort of deal, just a good tick the box in a good area. Like to diversify, don't buy 2 in Malaga, don't buy 2 in Perth in the same suburb. Mitigate land tax, mitigate risk, diversify the locations. Every state's got a different economy, but just diversify. And then that's part of it. I'm not going to go buy 5 properties in the same area, which is one of my negatives that I did kind of with my resi portfolio. I bought 5 in Brisbane, one after that, because I thought it was a good spot, which there was no real purpose to do that. So this one was at the front of the complex. The tenant was, I think it was an engineering company. Yeah, it's a civil contracting company that's been around for 20 years. Triple net lease, they paid everything on this one, even property management, which is really cool. So it makes my job easy looking at kind of net yields. Nothing fancy. Now, today, like back at the time, he only had 18 grand passive income. Now he's got around 40 grand just from 2 assets. And I probably want to take a moment to actually point that out. Like, we haven't spent ridiculous amounts of money. Without sounding arrogant, like I know 630 grand is still a considerable amount of money, but buying a 630 grand and a 740, which is medium house price of Sydney, within a couple years, he's got a 40 grand passive income, which is pretty powerful. Again, don't want to sound arrogant, just putting 30% deposits on this is a big chunk of change to get into it. Like you're talking, what's that, about 550, 600 grand? So it's not a small amount of money to get that passive income, but that passive income now is just going to keep growing and growing and growing. And within 10 years, and I can show you some spreadsheets that forecast that with rental increases, you'll have 100 grand passive income. Try to show me a residential portfolio that was 1.2 mil that has 100 grand passive income in 10 years, and I'm all ears. And that's the main power of commercial. Don't want to sugarcoat it, and I'll show you some due diligence, guys. There's a lot of spots you can burn yourself on this, and there's a lot of risk with it if you don't know what you're doing. But that's why I emphasize the point of just buy to the fundamentals so you don't have to worry about most of those risks. Most of those risks comes from chasing yield or buying an area that you don't understand. So if you buy in a well-equipped area that we understand, tight vacancies, good population growth, really good infrastructure spending, and well kind of diverse economy, you'll kind of be okay. All right, this is one where he's had the money and he's pulled out the considerable funds and got some extra contributions from elsewhere. And we've bought the big one to think. So the first 2 were dip his toe in because he didn't believe me when I was telling him about passive incomes and how it kind of work out. And this one, when I mentioned at the start about how I typically won't buy really regional because of the risk of lack of capital growth, lack of rental increases, like a high chance of vacancy. There are exceptions. So this one was purely a yield chasing one, but we mitigated the risk by buying a multi-tenancy asset. So we've got, it's like a whole retail center with a Subway, Gloria Jane's, all that type of stuff. And we got the yield to match. So to mitigate the risk in terms of vacancy, so if one of these shops goes vacant, we looked in the DD report, and I'll show you, it's typically 6 to 12 months. But by having lots of tenants, you completely mitigate that risk, because if you lose 1 in, say, 15, it's not as big a deal. Point to note, retail, however, can actually be lower risk in a regional town than it is in a capital city. So an example of that is if any of you guys from Sydney walk around anywhere, the CBD or Bondi Junction or anywhere like that, there's vacant shops everywhere because there's actually just too many of them. Whereas like a well-structured and planned regional town, there's actually not that many kind of retail centres. So there'll still be the little quiet small one, which will go vacant, but if you're in a main centre, the vacancy rates are really tight. I ran 22 kilometres on the weekend for the Blue Mountains Ultra Trail Australia race. Blue Mountains, Katoomba and Lura, you walk down the main street, because there's only one main street, all the foot traffic go there. I counted 2 vacant shops in about 200 in the Katoomba and not one in the whole street of Lura. So you can actually have a tighter vacancy rate in a regional area. So don't be put off if you are looking retail. However, be mindful of industrial. There's a lot more land and they can obviously build out and oversupply really quick. But retail can actually be a safe investment there. I'm just going to show you how we actually present our DD reports. We used to actually present this with about a 100-page PDF report, but we found most clients were just getting overwhelmed and they just kind of literally call you as soon as you send it to them and be like, Steve, is it a good property or not? And they didn't. So we actually created an online portal where we actually just summarize all the information now. So you can kind of read a summary and then you can actually click the link to download and actually see what we've cross-checked there. So we do like summary. So you can see on the left here, you can like go to lease. Cool, here's the leases. Here's what we've checked on the leases. Are they all good? There'll be a big cross if there's an issue and some reasons why that's a big cross. And then for them, if you don't trust us, cool, click the file, download them, cross-check them all that. So we go through every part of it. So we do like lease review, contract review, tenant interviews, which something like this is a big one because you're interviewing and looking at multiple tenants, P&L statements, rental ledgers, talking about their competition in the area, etc. Yeah, lease review, contract review, tenant interviews, road and traffic analysis, vacancy study, occupancy study, check the service contracts, foot traffic, road traffic analysis, etc., etc. But you can see here, like I'm only halfway through. We go through, check the titles, check the fire restrictions, check all the compliance, service contracts, asbestos registers, etc. So here's an example. So like we couldn't actually get some of the fire safety certificates, and that we need to take that on board when we're making a decision. But this is generally how you'll get all the information. And on average on a commercial deal, you'll get around 80 PDFs and files that you need to cross-check. This one had about 180, so just because there's a lot more tenants. But you can just see, we go through and check measures approved and occupancy certificates and all that type of stuff. So this is our new system. We only implemented 6 months ago, but we find it a bit easier now. If they've got a question about the lease, they can literally click the lease button, go to the lease, check it out. Obviously building and pest inspections and that type of stuff. So this is a cool little way we present the properties to clients now. But there's that. So for Alex, he still wants to go. He still wants to keep traveling around the world and doing that stuff. But because he's got equity now and he's got his big one, he's probably going to go for one more $3 million asset and then see how he goes over 5-10 years. My suggestion is he'll probably just realise the cash flow is really high and he'll probably pay him down and get him to a low LVR and live off the passive income. He does want to potentially, because he's got his residential still, sell the 2 residentials in the UK, then maybe even sell one of the smaller or both of the smaller industrial properties we bought him and then buy another big one. So effectively have 2 or 3 larger assets, which is personally my strategy as well. If you guys have been following me, I've actually sold pretty much all my resi portfolio and I'm going to buy 3 to 4 mil kind of commercial properties. I built the little shopping centre 3.1. Next one's probably a 4 mil type industrial complex. So that's my strategy. But what I want to actually show you, I've basically just put his whole portfolio together and averaged out the net yield over the assets and things like that, just to show you the spreadsheet that I showed you before. Nothing special. He's actually getting a bit more than a 40 grand depreciation because of the shopping centre, but I want to keep it realistic because he might not have bought something new. This is the passive income he's now got. So like I've taken out 6.5, I don't know why I've done that, but you can see 70% LVR on his portfolio. He's now 164 grand passive income. And then depending on the interest rates, like I said, if it goes up to 7.5, he's 92. If it goes down to 3.5%, he's 230 grand. So that's a cool little passive income he's now got with not a huge portfolio. Again, without saying arrogant, 5 mil is a good portfolio, but I know lots of resi investors that have got like 5 to 10 mil portfolios and they're actually costing them 150 grand to hold. He's got the opposite problem. He's got 150 grand positive for the same size portfolio. But the real fun part for me is this. If he just does nothing, so I've been conservative, 6.5% yield, rental increases, we can make that whatever, let's go 5%. Loan rate 6.5, he's actually around 6.2 now, so let's just fix that up. Not taking into account depreciation, which will actually speed it up, but I don't use depreciation in my cash flow calcs because at some point you're actually going to have to use the depreciation to fix up whatever's depreciating. But here, so you can see it's about 112 passive income without the depreciation. All this spreadsheet is doing is looking at his portfolio and putting that 112K into his remaining debt. So he's got a 70% loan to value ratio. It's actually a bit less, I think it's about 62%, but let's just go with me in case it was all lease stock. Then that becomes, instead of having a 3.6 mil debt, he's got a 3.5 mil debt. Then obviously the cash flow will increase and then pay down the debt faster because there's less debt, less interest repayments, more rental increases. And then quite simply, you can see at around the 11-year mark, he is debt-free. Like, he's done nothing. So as long as he's happy working for 10 years, again, this isn't Alex's strategy. He's going to buy another one because he wants to keep doing the skippering around the world. As long as he just sits there for 10 years and just keeps doing his day job, let it ticking along, at 11 years, he's going to be basically debt-free and pretty much a 500K passive income. And I know some of you guys are probably going to chime in and be like, oh, what about tax? What about this? Yep, we can take into account all that, and there's depreciation, then we can split up the trust and beneficiary. There's all fancy things, but this is purely illustrative. It actually happens, knocks off a year or two if you actually do it monthly. I'm just doing it yearly. But that's a pretty good position to be in, to have a $500,000 passive income in 10 years. And he doesn't necessarily have to pay off the debt anyway. He might be more than happy with 300K and he just keeps it at 30% LVR. But this was my big light bulb moment for me personally. When I actually looked at my commercials that I own and actually forecast the next 10 years, I was like, yeah. The negative with this strategy is you're leaving leverage on the table because arguably if he's got some servicing, he could go out and buy an extra 5 mil worth of assets for residential, for instance, and get 80, 90% loans for that and have a bigger portfolio. But instead of having the few $100,000 passive income, he's going to have a couple $100,000 liability. However, with capital growth, if in 10 years' time that portfolio doubles and he's got an extra 5 mil portfolio size, he'll have an extra 5 mil worth of net worth. So it's a balance between, do you want to be really wealthy in the future or do you want a bigger passive income now? And that's a question you guys need to answer. For me personally, it's all about cash flow. I actually don't care. I hate the buyer's agents that boast around their 30, 40 mil portfolio. I just want the passive income. If I can't have a good life on $500,000 a year, I need to reassess myself anyway. I'd rather enjoy my 30s and 40s than wait till 60 and say I'm worth $30, $40 million. So it's you just got to assess what you're actually trying to achieve and what time you want to do it in and just be true to yourself. Like actually work out what will make me happy. I can tell you, the more properties I got in my portfolio, I actually didn't get any happier. Like when I got up to 9 residential, I was the wealthiest ever was, but I felt the poorest I ever was and I actually wasn't happy. Whereas having a few commercials and a nice little passive income, I know I can shut down Palise property tomorrow and I'll be okay. Whereas with the resi portfolio, you have the liability. So you just got to find your comfort levels. Where does land tax fit into the calculations? Thanks, Bill. Land tax will take into account if you have to pay it. Typically, the tenant won't pay land tax if the property is under the land tax threshold. So what I mean by that, if you're buying a $600,000 warehouse, that's not going to push you over the land tax threshold because the land component's only $250,000, for instance. They won't pay that. They're also not going to pay your land tax bill if you own 5 properties in Brisbane and that one pushes you over the limit. However, if you buy something like a big industrial complex for 10 mil and land tax, that's over the land tax threshold, that will be part of the outgoing. So the tenant will actually pay your land tax bill in that instance. If it's a gross lease and they don't pay things like land tax and property management and all that type of stuff, then you'll take that into account when you're working out your net rent. So you don't go out and buy a 6% yielding property that ends up being a 4.5%. You negotiate it so it's a 6% net. But yeah, good question. Tenants typically pay, or if it's under the land tax threshold, it's not their problem. You'll have to work it out. The same deal for residential. Really good question. So how do you allow for damage by tenants? Depends what commercial we're buying, effectively. Something like industrial property, there's not a lot that they can do. Like they'd have to really smash a garage door or something like that. They're actually liable to fix it. However, you can actually still get insurance. So you can actually get machinery breakdown and damage insurance. So if you want to pay, it's not expensive. I think it's about $250 a year. And if someone damages the roller door, the insurance will cover it. But typically because they're covering all the outgoings, they are responsible for any damage. That's why you have bond and guarantees and security and all that type of stuff. If they're going to move out, they have to bring it back. It's called a make good clause, back to the existing condition. But tenant will always pay if it's their fault. If it's an existing damage, cool, it's probably on you. Like I got a retail shop in Queensland. The tenant moved in, the property was unpainted at the time and a little bit grubby, but they were happy with it. They've asked if I can contribute 50% to paint the new one, which I actually accepted because I think she thinks it's fair. Like they didn't have brand new paint when they moved in, so I'm going to contribute, and it still works out well for me by the time I get 50% back on tax. But yeah, tenants will always typically cover it. Where it becomes a grey area is if they've put something in and then they damage it and then they're leaving it when they leave. So like an example would be if they do, I don't know, a commercial kitchen and they pay for that and then they say, oh, I don't know, they don't like it anymore, they've damaged it, they're going to leave it there. That's when you're going to have an argument and you have to make sure the lease has the make good clause, perfect for, are they keeping it, are they taking away, who's responsible for maintenance of it. Actually, that's a good point. The one that we normally get tripped up on is service contracts for air conditioning. So typically, like they might be responsible for the air conditioning maintenance. You need to make sure that in the lease agreement, a typically designated amount that you'll cover for the air conditioning maintenance. And then this is where a good property manager comes in. Make sure the property manager is ensuring they do all the maintenance of those assets, because we've seen in the past with properties we've tried to buy where the tenant leaves and they say the aircon's working, and then a new tenant moves in, they say the aircon's not working. You can't really go back and get the tenant to try to fix the aircon and prove that it was them. So that's why doing all this due diligence before you buy the property and when the tenant leaves is critical. And I can't stress this enough. Don't try to manage a commercial yourself unless you're up to date with the stuff. Even simple things like fire checks. If you forget to do a fire check and the place burns down, it's very unlikely the insurance is going to cover you because you missed that fire check. So making sure your property manager who's got all the processes and due diligence checks in place will just cover you that as well. Okay, the next question we had from Romana is it principal and interest loan or interest only loan? The examples I used are interest only. Behind the scenes for most clients, if they're going full doc, a lot do principal and interest. I typically don't present principal and interest though, because for some reason, investors look at when you show cash flow on a principal and interest, they see it as a negative. They go, oh, I'm negative cash flow, 30 grand a year. But principal isn't a negative cash flow. Principal is, I call it bricks and mortar bank account. If I was going interest only and then they're putting 30 grand into a savings account, you wouldn't say that's negative cash flow. So I always present it with interest only. Obviously, if a client says, like, can you show me what the cash flow is, principal and interest, we've got those spreadsheets and you can download them on our website where it's called the stress test calculator. You can change it between P&I and interest only and change the loan terms and all that type of stuff. But the principal for me is like savings. It's going into an account that I know I can extract elsewhere. Sometimes you'll actually do principal and interest without having a principal and interest loan. So me personally, I've got lease stocks. I've got an offset account for one of my residential properties that I'm putting extra funds into there to offset the interest. So I'm paying off a principal effectively, net result, but not really. But it's just because I want the control of the money and not have the banks to have the money. Does that make sense? Bill, I've been burnt in resi and sold. Yep, me too. I've had times where I used to boast around my 50 grand passive income from a resi portfolio. And that's what I'd tell clients when I was a resi buyer's agent. In reality, the 50 grand was actually 20 grand tops because there was always an air conditioner blowing up, a roof leaking, changing taps and plumbing and blah, blah, blah. And the more properties I had, the bigger it was. And that was something I learned as well as part of a strategy was when you start getting a bigger portfolio, holding lots of small properties can actually be a hindrance to your cash flow. So yes, you might buy 10 properties that are lower priced that are 5 grand a year positive, whereas you could probably get away with 3 higher end properties that might be 25 or 40 grand a year negative. The net result between them is actually not that different. It's actually probably only 10 or 20 grand by the time you're taking on maintenance and things like that, and then changing of tenants and repainting carpet, etc. And that's where I've sort of learned as I've got wealthier and wealthier and my portfolio grew. I'm all about kind of managing the portfolio and looking at the difference in cash flow with those expected costs. And that's where a lot of people get sucked into the resi is they go, oh, look, buy this boarding house. Look how well it is. It's 30 grand a year positive. that's great, but when you got to replace the carpet every single year for 20 grand, who cares about the 30 grand positive? Then when it's university holidays and it's only tenanted 2/3 of the time, cool, it's not the 30 grand positive anymore. And then there's always something behind the scenes. Lease with commercial, the only thing that you can kind of cover up if you're trying to sell it to someone is the vacancy period. And that's the risk. So as long as I can show in the due diligence report that it's 1 to 6 months vacancy, cool. As long as it stays tenanted on average every 7 to 10 years and I have 6 months vacancy, my numbers are still strong. It's still 6% is now a 5.9 kind of thing. So that's the balance and why I like commercial. Again, if you get it right, you go out and buy a regional property in a mining town and the mine closes and the property sits there vacant forever, it's a disaster. So that's probably the main thing you want to take away. Well, good question. Realistically, what sort of deposit would you comfortably get you started? To answer the question, I'd probably say 200 grand is a minimum, so you can start moving into like 550 grand assets. We bought one a couple of weeks ago for 400 grand. The issue with the little 400 grand warehouses are you're not going to get a lease stock loan because there's no way a tenant's going to sign a 5-year lease that actually has a proper guarantee on it because it's going to be an average Joe's electrical wholesaler or whatever it is. It's going to be a small 1 or 2 man band. So they're only going to sign probably a 12-month lease. So it'll be 12 month by 12 month by 12 month. Most small businesses go one or two ways. They're going to outgrow the spot in 3 or 4 years, or they're going to close up shop. So you're actually going to cycle through a new tenant over and over and over again. So it's not a bad investment. It's just be mindful that you're going to circle through tenants and have to go full doc. You're not going to get a lease stock with those. My brother, for instance, who works with Palise property, his strategy is actually buy lots of 500 grand warehouses all around Australia. And he likes the diversification of having lots of assets in different locations without having to put a lot of money down. I'm the opposite. I only want a few good assets and not have to stress about it. So it's just different parts in your journey. I think the best spot is if you start looking 700K plus, you start getting into the 3-year leases, which gives you more opportunities for lease stock and a bit of comfort where you're not stressing about the property every 6 to 12 months and having to deal with property management, which by the way, erodes the lease. So how I was bad-mouthing boarding houses before, that's probably another one to point to note. If you're buying a little cheap warehouse, for instance, and it's not on a long lease, property managers for commercial have a releasing fee. And it's typically somewhere it depends on the budget, but for a small one, it's 15 to 25% of the first year's rent. So you might go, oh, bro, I've found this 500 grand property, it's a 6% net yield. Cool. If it's a 12-month lease and they're taking 20%, it's not a 6%. It's actually less than a 5% because they're going to take that 20% of the rent for releasing. So there's all those little ones, whereas a bigger one, they do that year one and then for the next 3 to 5 years, they just take their 5 to 7% management fee. So that kind of gets the balance there. Is commercial serviceability calculated differently to residential? Yes and no. So for a full doc loan, typically yes. They do the same shading criteria. So they'll take the rent, normally take 20% of the rent off, and they do the same thing residential. They do a higher interest rate, so typically 1.5 to 3.5% extra interest rate. And they look at principal and interest. So you need to be able to afford, even if it's an interest-only loan, principal and interest, higher interest rate, lower rent that you're actually getting, and then see if you can afford that. However, be mindful that typically, loan periods are shorter in commercial. You can get 30-year loan terms, but most people get a 15, 20-year. So that actually reduces the servicing a little bit. But you got to remember, if you're buying a 6% net yield in commercial, most resi at the moment is around 4% gross, and that's in a good area like a Brisbane and Adelaide that has a decent yield. 4% actually equates to around 2% net by the time you pay council rates, water rates, maintenance, outgoings, all that type of stuff. So I'm actually getting 3 times more rent. So commercial doesn't add to your servicing as much as you think, but it doesn't take away like residential does. So like an example would be, let's just go $1 million asset. $1 million residential property is 20 grand a year negative cash flow at the moment. When you apply that criteria, it goes to about 40 grand negative in the bank size anyways. Commercial property is 20 grand a year positive in that instance. When the banks apply their criteria, it goes to like neutral. So the resi is losing servicing because you pay out of your pocket to hold the property. The commercial's not adding to your servicing, but it's not taking away the same. So normally it means you can stretch an extra property or two with commercial where you couldn't with residential. And this is part of our strategy. When we talk to clients, you need to talk to a good broker that knows where that glass ceiling is. And that's when you'll typically make the change to commercial. So if the broker comes and says, oh, look, John, you're good for 1.2 mil residential capacity, and that's based on your servicing, not your capital. Say they've got their house paid off. We know that we can't buy, if we buy up to 1.2 mil resi, we're done. We're sitting on our hands waiting for interest rates to come down, the person's pay to increase, or the tenant rent to go up. And that's kind of sitting in hand. Whereas if we want to kind of massage a little bit, we might go, okay, maybe we buy 600 grand residential and then another 600 grand commercial, knowing that as soon as we get the equity in the commercial, we can buy another 600 grand commercial because the servicing isn't as big of a deal, or potentially move to the next part of the answer, which I want to say is lease doc loans. So I answered the first part about full doc loans. Lease doc are a different kettle of fish. That's where basically the rent, as long as it washes its own face, they'll give you a loan. So at the moment, actually, let's have a play. This is, I'll probably get in trouble with this because I actually taken the major banks' criteria for what they do for a lease doc loan and basically shown you what they're going to loan you for a lease doc loan. Basically, if you want to buy a 500 grand property, you're going to need a 245 grand deposit because they're only giving you a 50%. So for that to cover itself when they do the, because basically the interest coverage ratio is an extra 50%. So you need theoretically, if you want to get 100% loan, you need 50% more rent than the interest rate. But we're not getting that. We're getting 6.79 and 6%. Hence where the LVR comes from. So lease doc is basically a way you can infinitely buy with no issues with servicing because the loan is based on the property itself. The rent covers it. If you get a property with a 5-year lease, they give you a 5-year loan. At the end of the 5 years, you get another lease doc loan. The issue with this one is because the maximum you can get is in a 70% LVR is the deposit. So servicing is no longer the issue. If you want to buy $1 million asset, you need 350 grand. 300 grand deposit, 50 grand for stamp duty, legals, all that type of stuff. That's the hard part in this scenario, getting the 350 grand. But a lot of resi investors will actually have enough servicing to pull out 350 grand equity. They just don't have enough servicing to leverage another residential property for that 350 grand to turn into a mill. But if you can actually get it out from the banks, that 350, then you can buy a commercial. And this is where commercial lets you push the limits a little bit more than residential. But have a play with this. This shows you what the different lenders, what loan to value ratio are. You can actually change based on like, cool, if these are the scenarios, how much deposit you need for your purchase price, or you can change it for what's your max borrowing for the funds that you have. So if you want to put in like, oh, cool, I've got 500 grand in an offset account, put in the 500 grand, and it'll actually show you what the different lenders, your max purchase price will be for this situation. How would you approach self-managed super fund investing with a lower balance and resulting properties, i.e. 500K properties? Normally there's two methods of attack for self-managed super fund. I typically encourage if you've got a smaller amount, just buy a bulletproof set and forget. So the only thing that'll actually change in a self-managed super fund, again, depends on your age. Let's say you're club 40, you're 40 years old. I know you're gonna have 20 plus years of working. Let's buy a property that's just no problems whatsoever. You don't have to think about it. It guarantees a return, always stays tenanted. That's for that one. If you come to me and you're 63 years old, cool, buying a set and forget is great, but we might buy something like the shopping center we bought and actually chase yield a little bit more because cash flow is more important than the capital growth in that one. So there's the other strategy. The other one that comes up probably with around 1 in 10 clients is people that have a little bit more in their self-managed super fund and have the opportunity to do a value add. There's some powerful things you can do there because we can buy, say, $1 million asset where we're going to throw 150 grand into like a mezzanine floor or something like that. Put that in when the tenant leaves. You need the cash for this because you can't refinance the property. Put it in, get it revalued, and if there's value there, sell that asset and then buy a bigger one. And we've had a client, we've done this 5 times. They got up, I think it was from 750 over the last 5 years, and now they've got a $4 million asset just by doing that strategy. But again, not risk-free. They've paid to play. They've put big chunks of self-managed super fund money into a value add. So you can theoretically do everything. The only negative of the self-managed super fund is you can't refinance a property. So once you've got it, that's it. There's a pay down strategy or a sell strategy. So they're the two mindsets you need to get into. Question from Randall is, I'd like to know how you can achieve a capital growth of 6% plus if the rental increases are locked in at 3%? If a property value is so closely tied to the net income? Really, really good question. And I used to actually ask this all the time and actually thought wrong about it. The market will demand what the cap rate is. So in an instant moment in time, when you value your property, it's typically done off the net operating income, and which in turn goes to the cap rate. However, you can still have cap rate compression. So an example is Brisbane. We were buying 6% plus net yields a few years ago. Now some areas like Eagle Farm and things like that, they're selling sub fives. So the rents have actually gone up, but the cap rates have actually compressed due to demand. So similar to resi, you can still have capital growth and cap rate compression. However, most people in this room, and no offense if you're one of the high net worth individuals in here, aren't buying properties where that's going to change dramatically because you're not buying 10-year leases. So even if you incorrectly signed a 5-year lease 5 years ago and it was on 3% fixed rental increases, which wasn't bad. 5 years ago, if you got 3 to 5% fixed rental increases, that was an awesome outcome because it was higher than inflation. However, inflation's been higher, and we've actually seen, especially in industrial, around 20 to 30% rental increases. You'll bump up the rent as soon as you get to that end of the 5 years. And that's the worst case scenario, because most people are a 3-year, 4-year, 5-year. At a 5 years, so you've only really missed out on that difference. So like if the market's grown by an extra 3-4%, and it's $1 million property, cool, you've lost 25 grand over 5 years effectively of rent that you could have got. That wouldn't be not something I make my decision on. I get clients that walk away from properties because I present them and I say, hey, look, it's 2 years left at 3%. And they go, oh no, I want 5% or CPI. And I go, well, it's literally a 5 grand decision. Like, why are you focusing, buy a better quality asset, knowing that when it gets to the end of the lease, you're going to bump the rent up to market rate anyway. But yeah, to answer your question, you get cap rate compression, and then that rent is just going to basically come later on anyway. Because when you're doing your valuation, they'll look at comparable rents. They'll see that it's under rented. The value will still probably value it because of your low rent, but you know in a year or two's time, it's going back up to market rate, which is typically when you value commercials. When they get to the end of lease and they sign the new one at market rent, you'll go back and get another lease stock loan or go back to the lender and pay for the valuation. All right, Steve, what has always stumped me is that my initial 160K deposit, that will cost me approximately 12K extra on my current mortgage, so won't be negative equity. Yep. All right, so this has been the hardest thing with commercial. 5 years ago, commercial was an easy sell because interest rates were 3.5% and yields where I was buying 7 to 9%. Funnily enough, people at the time still found a reason to argue. Like you'd send them something at 7%, they go, oh, I'm not saying yes to that, I want it to be 8%. And we're buying blue chip assets in Brisbane. The same thing's gonna happen in 5 years' time. They'll be like, oh, I wish I bought a 6% yielding asset when interest rates were 6.5% when they came down or whatever it is. You won't win that way. If you're going 100% loan, you're gonna be negative slightly. So like, we'll use round numbers. Let's say $1 million asset, 6% net yield, 100% LVR, 6.5% interest rate. That's gonna be 5 grand a year negative on that property, just owning that. Which seems like, oh, Steve, you're telling me about this passive income I'm gonna get. Nothing's free. You're not gonna just flick a light switch and become a billionaire kind of thing. However, you do that same scenario for a residential, one's 5 grand negative, the other one's 45 grand a year negative, so you're gonna get there sooner. It just means there's a delay in the passive income. So that 5 grand on the 60 grand, we only need 2 or 3 rental increases, and then we're in the green. We're positive. Then after that, it starts chipping away. You probably pay down, the market's probably gone up, the property's value's gone up as well. So yeah, it's not a get rich quick instant one, unless you've got a cash deposit, then you can. And that's why I personally sold my residential, because I could have leveraged much more and bought a 10 mil commercial, but for exact your reason, it would have been neutral. And I'm kind of like, well, I don't want to be neutral for the next 5 years. However, if you're, sorry, what was your name? Kirk, if you're in the foundation stages, unfortunately, it's just a tough luck. Your aim in the accumulation phase is to hold as many assets as you can and get a bigger value portfolio as you can without being too detrimental to your lifestyle. So if you can afford it and you bought 3 of those properties and they were obviously number 12 grand a year negative, as long as you can handle 36 grand a year negative, I will guarantee you'll be in a better position in 5 years' time. So like that's the gamble. I could be wrong. Interest rates could go to 12%, major recession, Trump starts bombing the world, and that's out of my control and that will happen. But not buying an asset, even if you don't buy property, got to do something. Business, buy shares, do crypto, do something. You need to do something if you want to be ahead of just earning an income for your whole life, because we're going to live to 90 or 100 most likely. So to get a bit of a nest egg when you got time on your side. Can you work with, say, 450, 500K cash for a lease stock? Yeah, that'll get you a 1.4 mil asset, which is a really good blue chip asset in a capital city. So you can definitely work there. Like I said, if we get a 6% net at the moment, that's a 70% LVR. That's where I got that number from in the quick calcs. If we get a 5%, it's probably around a 65% LVR. So you probably sub a mil. You're probably like a 950 grand commercial. So still good assets down there. One of the things I actually want to point on, I keep getting these experts in the industry that say, don't buy sub $1 million commercial properties because there's too many buyers in that price point, which I actually find a bit of a weird statement to say. It's kind of saying, don't buy in the price point class where there's lots of people buying. But if you're in residential and you have 100 people turn up to your open home, isn't that a really good indicator for capital growth? So I want lots of people interested. Like my little shopping center I bought, I overpaid that by about 100 grand because there was 4 other unconditional contracts on the property. So I was like, cool, if I need to do a fire sale in 2 years' time, there's 4 other people I can flick the property to. The negative with having lots of people in the price point is you're not going to pick up a bargain. But I'll tell you this anyway, typically when you're spending 3, 4, 5 mil, you're not getting a bargain anyway. Like you might save 5%, but for $1 million asset, you shouldn't be focusing on trying to get 2 or 3%. I've had clients walk around a property like presented at $1,020,000 and they go, no, I'm not saying anything less than $1 million. And then it takes us 3 months to find a property and then the properties are $1,050,000 anyway. So it's kind of like you've just walked away for literally a 2% different in price. And that's what I said at the start of the presentation, just focus on quality. That will win amongst all else. Is there a fundamental portfolio size, cash flow amount before you start investing to more regional purchases? Chasing cash flow, some growth is the end game strategy. You can still do really well with the regional, depending on the asset that you've bought. However, what's the word I'm looking for? It's confidence. So I'm going to say it's a confidence rating in buying a property. If I buy a property in North Sydney, for instance, a warehouse, we've just got one in Chatswood at the moment, this week under contract, warehouse in Chatswood. North Sydney has a 0% vacancy rate for warehouses, for industrial stock. And if you don't believe me, go on CBRE, Savills, Knight Frank, they do half-yearly reports. Look at the half-yearly, 0% in North Sydney. That for me is a way bigger confidence rating that I am going to get capital growth, and it's not guaranteed, than buying in Mackay where the vacancy rates are 7-8%. And I'm not saying that still might grow, but I get more confidence in that market that I'll get rental increase and capital growth. But to answer your question, the portfolio size is a hard one because it's all relative. Like a 10 mil portfolio for me is completely different to someone who's aiming for a 2 mil portfolio. Sometimes you'll actually have to go regional because you don't actually have the deposit to go into a big capital city. So like if you got 300 grand, I can find some really good retail in regional towns for 300K with 5-year leases where we can mitigate the risk that way. Whereas if we go out and buy a 300K warehouse in Sydney, you are getting 12 square meters of land. It's a car spot in Western Sydney, which zoned as storage, can't do anything with it, probably less capital growth. So it's just balancing the right, like, I always say this on calls, what you're actually trying to achieve and what time frame. And then, because some people are different. Some people just want a 50 grand passive income. That's a different strategy to a 500 grand passive income. And then the third factor is what your finance actually allows will kind of dictate a little bit. Just another little piece of education. A lot of lenders don't actually like regional properties. So we've got an in-house valuer that looks at it, but we know the banks do this as well. They'll do postcode restrictions on certain areas and also types of assets. So like a lot of lenders don't like office space. And then they really don't like office space in regional areas. Some of them even don't like retail in some areas. So they'll postcode restrict that. So you might think, oh, it's great, I found a 7% yielding retail in Mackay. Cool, the banks might only give you a 60% lend on that. So you might have been better off buying one in Brisbane because you're gonna get a bigger LVR and end up being the same price anyway. So just be mindful of that. Hey Steve, tenants as mixed medical offices will likely be approval for a 75% loan. I don't know, because it's mixed, I'll have to look at the proportion. If it's full doc, you can actually get up to 80%. So that's the case there. There's two parts to that answer though. If you're a medical practitioner and you're buying, you can actually get 90%, even 100% to buy a medical practice, but that's because they're going to operate in it. If this is for an investor, no, like I said, probably 80%. If they're a doctor investor, there's some like doctor lenders that can kind of do that, but generally, no. Like if you're going lease doc, 70% maximum, full doc, maybe 80%. This is one I always get asked actually, so I'll probably go on a bit of a rant here. People seem to love medical centers, and I do too, but be aware they're also risky. So people say they're not risky because they're a stable business, which is actually right. The risk comes with if the actual medical center closes, you've got a purpose-built asset, which is typically like an office space, effectively. So let's just say you buy the second story of a retail center where it's a GP medical center. That's effectively an office space because it's not going to be a retail, even though it's a medical is a retail. The next tenant on that's going to be an office space. You're probably going to pay a 5% net yield for that doctor surgery. If in 7 years' time they leave, the cap rate for an office is like 7%. So you've just paid like a 30% premium for that property, and that's going to drop as soon as they leave. And that's the risk. So yes, they're a secure tenant, but typically the asset that you're buying into is one-dimensional. So it's an office. A lot of people go, oh, what about if I buy a freestanding medical? Cool. Probably even worse because you're buying literally it's the same argument as a childcare. It's purpose-built for that. If they leave, you're kind of stuck in another childcare or medical, and that's the risk. So I'm not saying I'm against them, and we've bought childcare and we've bought medical. I personally like the retail medical. If you can get ground floor shop front, like the ones you walk past that have foot traffic and they're like a dentist, that's perfect because if they leave, it can still be a hairdresser, barber shop, cafe. It's got all those other uses, whereas the one on top, no other uses. That's an office space, and that's pretty much it. But again, there's always exceptions. I always say things like, I hate office. I would not touch office. We bought one in Balgowlah on the Northern Beaches. It was a little 2-story building. We actually bought the second floor. We got a really sharp yield. It was close to a 7% net, which is effectively an office space. But because there's not much office space in Balgowlah because it's basically a residential area, we got a high yield, and the vacancy rates when we actually did our due diligence were actually quite tight. It was around 6 months to get a new tenant. The tenant at the time was actually a ballet studio, which I actually kind of liked because it's doubling up as a retail. Like that could be a little personal fitness studio or a ballet studio or an office or a mixture of both and things like that, or a consulting room and things like that. So I'm not against them, but you just got to take on the vacancy risk, look at versatility of the asset. This is going to sound bad. Unless I'm buying a 5-year plus tenant and there's not a big fit out, I actually don't care who the tenant is. And I know that sounds silly if I'm buying like an industrial property. You will lose your tenant at some point. Like it'll either be in 5 years' time, 10 years' time, 15 years' time. If you're planning to hold this asset long term, you should actually be worrying more about the next tenant, not who your tenant currently is, because you'll lose them. Funnily enough, the better tenant I buy you, the quicker they're actually going to leave because they're actually going to grow. If they buy your warehouse tenant and that's an e-distribution center, they're growing 30% per year, they're going to need 30% more floor space per year. So by the time they end of the lease, they're going to be gone anyway. Funnily enough, the best tenant's one that actually grows 5% per year. So they pay on time, but they don't go anywhere for 10 years. But again, you don't want to look for a mediocre tenant. So just always look at your asset and go, is this going to be a better investment in 10 years' time and in demand? Hopefully you keep your tenant for 10 years' time, which the medical ones, probably that's the argument why they're positive. But something like an industrial, you're buying the location, the space, and the versatility. The tenant is just the cream on top for that part of it. We've got a question from Ruffy. All these keen investors online and your existing client base, how do you prioritize who do you offer a good quality property to that has become available, especially if it's off market? I would assume many of the investors have similar budget. Yep, to be honest, we just do it fairly. Whoever signed up first gets first stab at it. So there's certain price points where there's more people, I'll admit. So like at the moment, we've got about 10 people in that kind of $1 million price point. If you signed up a month ago, or let's say 3 months ago, and you still don't have a property, you're getting every property first. That's in theory how it works. In reality, what happens is every time, there's a reason that person's been sitting there for 3 months, and it's because they've rejected a couple properties. We typically make you tell us what you didn't like about the property. And sometimes we'll actually argue with you. Like the common one is we'll send you a property in Perth and people go, I don't want to buy Perth, it's a mining town. So we send them literally council reports showing the difference percentage of different industries in Perth now, because it's no longer just a mining town. There's 4 or 5 other major industries. And they think, but again, it's your money, your risk. So they might actually say, I don't want Perth. That's fine. Then when the next Perth one comes on, it'll go to the next person in the list. So typically you'll get a property within 1 to 3 months. The sooner you sign up, the more properties you're going to get. And then everyone's got a different kind of nuance. So some people will be, and this is the hard thing with commercial. Some people are yield chasers. Some people want proximity to CBD. Some people want value add. Some people want something newer for depreciation. And all those will get taken into account. So when we find a property, sometimes I'll find it and I'll see number 5 on the list. I'll be like, John's going to like this way more than everyone else. I'll send it to John, kind of thing. However, if John says no to it, then it just goes to the next person. But to answer your question, that's probably the difference between me and other buyers agents. I want to remain, I don't want to say boutique because we're medium sized, but like I want to remain boutique where we actually just make sure we're getting good quality properties. I don't want to sign up 100 people that I can't service. And no offense, guys, I'll probably use my fees to control that. If we keep getting more and more demand and I don't want to buy 100 properties a month, I'll just increase the fees by 25% and do 25% less deals and make more money that way. So that's the honest answer. But yeah, it's just, we just do it fairly. Then as we move up in price point, the clients that have got 2 mil budget, 3 mil budget, 4 mil, they start to get more specific. Some want like freestanding, some want certain types of assets, some want a long lease. And then that's a specific search. But the bread and butter clients of good tenant, good location, low vacancy rate, versatile premises, that's just done fairly. It's just done one after the other. So I encourage you, if you want to sign up to our services, get in sooner, even if you're probably not ready, because if you sign up now and you say you're going to be ready in 4 or 5 months' time, you'll be on the top of the list. Has retail grown in a similar price to industrial in Brisbane in the last 3 years? No. So retail hasn't grown the same, and there's a couple reasons for that. Typically leases are longer and tenants stay longer. And then there's also been a flow-on effect from COVID where we haven't bumped up the rents similar to kind of what we did. So when COVID happened, e-distribution and e-commerce went nuts. So like all the industrial spaces were really high in demand. What happened with retail, and I've got a few retails prior to my shopping centre as well, that you gave concessions. So you typically weren't nasty landlord and bumped the rent up straight away. So there's been a lag with that. On average, they grow the same. Like you don't have a $5 million warehouse next to a 500 grand retail shop. They're going to grow the same, but there has been a lag the last 3 years. So we've only seen kind of 20, 30% increases in in retail in the last 5 years, whereas industrial's typically gone 50 to 60% in some of the good areas. So there is a bit of a lag, but big reason for that, land component. However, I hate saying generalized statements for retail because people just take what I say and think it's gospel. Retail is all about foot traffic, road traffic, where it is. Like you guys have probably been to little suburban strip shops where you can literally go to one in a suburb and then the one next to the suburb. The one in the adjoining suburb, you go there and they're all tenanted, but it's kind of like a ghost town. There's no one there. That one isn't going to have the same capital growth as the one next to it where it's thriving. You turn up and you can barely get a car spot and there's 15 people waiting for coffees at the cafe and the hairdresser's full. So when I say statements like that one's a good one that's going to have really, really good capital growth in the next 3 to 5 years. The other one's probably going to be a bit slower, 2 or 3%, but I can't encapsulate that in a general statement, which is also where most of the confusion and myths come with commercial, because people just go, oh, I saw a cafe near me it was closed and it was been vacant for 3 years. And then they just tarnish all of Australia with that, which is the wrong way to do it. Like they're not talking about like the cafe I go to has been there for 15 years. Like, cool, buy that one. Don't buy the one with no foot traffic. So that's harder to make general statements with retail. Industrial's a bit easier because it's like, cool, we're talking sub 1,000. Most tenants don't care if they're 2 kilometres away or 1 kilometre away based on it, whereas retail, it's all foot traffic, all road traffic. Don't listen to things like online spending's down. None of you guys are buying a Westfield, and if you are, you're probably not on this, no offence. You're probably off making way more money than me. So most of us are going to buy suburban retail. So just focus on that area's fundamentals and the road traffic, foot traffic, all that type of stuff. Do you have some guidance or advice around finding a good property manager? I'm pretty sure part of the Palise service. Yep. Okay. We recommend property managers, but admittedly, it's actually really hard to know you've got a good property manager until you need a good property manager. Because if I do my job well and buy you a tenant you don't have to worry about, who always pays their bills on time, the property manager is just doing his typical due diligence, checking service contracts, doing this, making sure the pay's come in. Where you know they're a good property manager is when the tenant's going to leave or there's an issue. So regards to me, like I've got a good sample size because I've done like 800 commercial properties now. So the ones that have had issues, I've seen how they've reacted, and they're the ones we'll typically recommend being like, hey, we had this happen. They got a tenant really quickly. But it's really hard. They all talk a big game and they say, oh, we're going to get it tenanted really quickly. My advice is the ones that are on the ground, have really good relationships with local businesses and push big marketing campaigns. Don't go off fees. Some of the really good ones are cheap and some of the really bad ones are expensive. Some of the mid-range ones are there. It depends on the area. Again, regional is different to capital cities. I've worked with all of them, so if you've got someone in mind, just literally send us an email and someone in my team would have worked with them and they can kind of give you some feedback. But again, it's hard for me because I'm hopefully not buying too many bad properties, so I don't have to experience those negatives that most people actually have to deal with if you're doing it by yourself. Jess has asked, in the accumulation phase with 500k equity to work with, for example, should we look at resi first or is there a place for buying commercial without using all the equity? I'll answer it generally, not for your specific case, because I already know what your numbers are with the broker. It's going to come down to disparity in borrowing capacity and where you are in your journey. So an example will be, say Jess's 500k, if she could leverage that up to, let's say she could get 80% loan to value ratio on residential because she's on a really high income, got really good servicing, she could go buy 2.5 mil worth of residential. So that's a nice big portfolio. It's going to be negatively geared though, and that's what we spoke about before. It's probably going to be negatively geared, probably close to 100 grand, depending on what we buy and where we buy. We could still buy residential in that, and we can mitigate that from like house and granny flat strategies or buy some more regional towns that are more cash flow neutral. So we can still avoid some of that. However, with that 500 grand, she's probably looking at 1.2 mil max for commercial. Unless we go on 80% loan to value, and then you might get a bit higher. So you might get up to 1.4, 1.5. By buying commercial, we're leaving leverage on the table for 2.5 mil. So if we say get 10% capital growth, she makes 250 grand with the residential of equity that we can at least do something with. We might not have servicing anymore, but might sell one or two of the residentials, realize that, and then buy another commercial. So now instead of having 2.5 mil, we might sell a couple. We've got a 3 mil a 3 mil total portfolio now. Whereas if we say buy 1.2 mil and we get 10%, that's only 120 grand. So we actually have to wait twice as long to be able to buy another commercial with that. And that's the balance. So it's looking at the price disparity in your borrowing capacity and then just aligning. To answer your question about leaving money on the table, it's based on risk profile. If you're a single mum with 3 kids, cool, let's not leverage up to the eyeballs to LVR. That's all about buffers and what we can actually basically worst case scenario. If you're a 25-year-old who's got bank of mum and dad to fall back on, like I did a couple of times where you move back home because you're struggling to make repayments and things like that, cool, you can push the dial a bit more knowing that you're generally going to be okay. If you're 64 years old, I'm not going to leverage up to the eyeballs and be negatively geared. That doesn't help the strategy. So it's this matching that up. But the first point of call is always chat with the broker, find resi capacity, find commercial, and then ask the question, is those borrowing capacities based on servicing or capital? Because that will dictate your strategy. And then we align that with what your actual goals are, whether we're going 50K, 100K, 250K, or portfolio size. I actually get clients that actually don't care about cash flow. It's normally the parents. They just go, oh, we want a portfolio to hand on to our kids so they can buy into the Sydney market. So it's actually like let's make $2 million any way we can with property so we can sell them and give assets so the kids can buy properties. So that's not a cash flow, that's a accumulation strategy. So just aligning all 3 of those things is probably the most important part. Do commercial property managers charge a higher letting fee than resi? I heard it can be up to 12% in the first year. So on average, yes, it changes based on the net rent that you get. So if you buy a $5 million commercial, you're looking at like 4% management fee. They all want to earn between 5 and 10 grand a year on average for a simple one. If you buy a 500 grand one, because the rent's not high, they're going to charge 15%. On average, it's a little bit more. not significant in the grand scheme of things. Like you're always going to out for a few grand. My advice, never try to scrimp and save $1,000, $2,000. If that is changing your life, either one, property's probably not right for you, or two, go pack shelves at Coles one night a week, make that up, and then not have to stress about it. When you start thinking bigger with property, the little problems are insignificant. I used to like paint all my own houses. I even laid carpet in one of my residential properties to try to save a couple grand. The property was growing like 50, 60 grand a year. So like that loss of 4 weekends to save $3,000 was missing the big picture. Like it actually didn't move the needle at all for my portfolio. It just wasted time. I could have been doing something else. Could have been focusing on education or buying more properties or whatever it may be. So try to focus on the big items and then just pay the professionals for the small items. But to answer your question, 5 to 15% is normally the range. They'll want to make 5 grand-ish. As an example, I've got a shopping centre with 8 tenants that I bought for 3.175 mil. I pay 20 grand a year, but she does everything. But that's because there's way more involved because they've got to do like the bins and the removals of things, the air conditioning, the roof checks, the maintenance, blah, blah, all the leases and deal with the tenant issues. So that's about a 20 grand total fee for that one. But again, there's 8 tenants, a bigger one. My other ones, it's typically 3 to 6 grand. Thank you so much, guys. Point to note, go on paliseproperty.com. There's all the resources. You can download the spreadsheets, due diligence checklist, lease stock calculator, portfolio plan. You can even go get access to my course from there or just go to Commercial Property Institute. If you really, really love commercial, there's a 10-hour free course that I basically go through everything that we do on a property. Funnily enough, we recorded around 20 hours of footage for that, but my social media team, who I'm in the studio at the moment, they said no one wants to watch your face for 20 hours, so we actually had to cut it down for 10. So there actually is more if you really want, but that'll give you the bulk of kind of what you need to get started. And if you're time poor, I just don't want to make a mistake, obviously reach out to Palise Property, we can have a chat and help you there. But thank you so much, guys. Been a pleasure, and I hopefully got through my first webinar successfully. Cheers, guys.